We may be able to pour all the good things in us today, or some of the good things in us today, so that everyone can be beneficial of this particular session. All right, so back to business. Now, trade settings. Okay, trade settings and then risk management. I'll first talk about risk management. Then we proceed with trade settings. Risk management in general and risk management in practice. Okay. Now, when I say risk management, one of the key factors that helps traders to be able to build up a strong foundation is risk management. Now, we have risk management on paper and the risk management in practice. Okay. So basically, when it comes to both sports and futures trading, risk management must be applied, especially on the futures markets. One of the key things that will let you out is if you don't apply proper risk management. So we have proper risk management and improper risk management. Now, let me give an example. Recent, I dropped a signal on the signal platform. That was 9th of 9th March. The day that I was celebrating my birthday. Now, when I dropped the signals, it seems it took like 10 days or so before the signal delivered. But most people who traded on that asset, some of them jump into my DM. They asked how far with the signal is it going to deliver. They are afraid because some people are saying broccoli is a very serious asset, it's a very bad asset. It can do this, it can do that. And I was like, hey, listen to me. When it comes to trading, the first key thing is not how fast a trade delivers, but how grounding you have got your trade. Okay, that is the first thing. So personally, I don't trade hype, I don't trade noise, but I trade with silence. So when it comes to trading, the first risk management that you can apply is the foundation, how to set up the trade. Necessarily not setting up the trade, but when I talk of the setup, not like inserting the trade, fixing the trade out, but how to source the trade, especially, is the first risk management that you can apply. So if you just make any bad entry, it affects you. So this may go to people that know how to analyze the charts. So analyzing the chart too, your risk management starts from how you analyze your assets or your chart. So personally, as I can set up a trade. Yes, so I do get liquidation sometimes, but I can set up a trade and I know that from the basis of my trade, even if I leave this trade, no matter the storms, I'm not afraid. I have to leave it and then be free in mind. That trade got delivered. Yeah, the trade got delivered. The same assets that people do complain, it got delivered. For 10 days, I was just observing the market, the storms that were passing through the market, the downs, the ups in the market. I saw it all, but the trade got delivered. Why? Because of risk management, right from the entry to the setup, entry setup to how you fix up your trade and then you open up your trade as well. Which simply means risk management is an important tool in trading. Not only in setting it up, but your entries, how you are able to analyze the chart and then also position your entries within a particular time really helps you a lot in your trading. So to those who do analyze the markets themselves, I will always tell you this truth. Proper risk management starts from how you analyze your trade. If you don't analyze your trade very well, listen, you can be making fast profits, but immediately a trade delivered small, it may rush up and then flash everything out. So the groundings of your trading is important, and that is the first risk management you can do or you can apply. Now, the idea of applying risk management, let me see if I can share my screen. Yes, I'm not sharing. Let me share my screen. All right. Okay. So the idea of risk management is to ensure that, one, despite the storms that happens in the market, you can be able to ascertain yourself and then also do what? Make profit, right? So we apply risk management to make profits or to cut down losses. Okay. We apply risk management to make profits or to cut down what? Losses. These are some of the key reasons why we apply risk management in trading. So the risk management thing that we've been talking about all makes sense in one thing, that a trader is thinking of how he can make some profits despite the storms that happens in the market, or he can cut down his losses, and they are all part of what? Risk management. So what I'm saying is that, now if you want to apply risk management, especially if you are the type that you've been analyzing the asset yourself, then the first thing that you have to do is to be careful with your entries. Now, we may all trade the same asset, but your entry will determine how sustainable you can be in that market or how easily you'll be liquidated. A bad entry may lead you to getting liquidated so easily, and a good or solid entry may help you to build a statutory trade in the market, which simply means you can stay solid in the market for some time. And personally, for some time now, the only asset that I do trade is broccoli. Broccoli, 741 or something. You can check it out. If it had liquidated me maybe twice or thrice in a within this month, sorry, within this year, and like I've been saying, the most important part of trading is not liquidation, it's not being liquidated or um losing money, but it is your ability to make consistent profits. Your results, your profits should be more than your losses. That is when we say you are a profitable trader. Okay. So it's not the absence of losses, but of it. So at the end of the day, your profit should be more than your losses. Even if you lose and you lose and it's happening that you don't lose much as compared to the profit that you've made, it's okay. The other part of it is about risk management is that, now there are some of you, your risk management is not on paper. Like I said, shouldn't be on paper. It's a mental risk management. Mental risk management. Mental. When I say mental risk management, some of you, despite the fact that you are trading the asset on paper, when I say on paper, it simply means you are trading on real markets. Now, assuming you've made $2 profit today, or you've made $15 profit, your capital is $30. Now, you've lost, let's say, $25. You become too hard on yourself. In a natural sense, if I have $30 and I've lost $25, it simply means I lost the profit plus $10 out of my capital, which is 25. So I have $25 remaining. If I'm right, is it 25? 30 plus 15, that is going to be 45. So 45 minus 25. Uh, all right, okay. So 45 minus 25, that is going to give you how much? Okay, that is 20, right? Good. So it simply means you have $20 capital. Now, what I'm trying to mean in essence is that you don't need to be too hard on yourself, because that money, that profit that you made, in an, in an actual sense, doesn't belong to you. It's just a profit that you've made. So in business, when you run a business, the most important thing is your capital. At least, even if you lose and you don't lose much of your capital, that is fine. So the means of protecting your capital, if I run a business and then I lose and then I realize that, oh, the money that I lost is the profit that I've made, it's fine. You can still go again. Do you get it? So whatever I'm trying to mean in essence is that when we talk of risk management, both on paper and then in our mind, we should be able to ascertain certain information and a certain understanding that no matter how things goes in the market, I have to get to a limit where I must get my groundings. So let's go. Now, both on sports and on futures, risk management is important. Like I said initially, risk management is what is important. So starting on the futures market. On the futures market, you set up a trade. So first, my preamble or the hypothesis, what I'm trying to formulate here is that setting up the trade, before you say that, okay, I'm setting up broccoli, hmm, you should have a grounding setup. Your setup should be grounding, should be grounded, right? Your setup should be grounded. That is the first thing. Second, how you set up the trade. And one of the unique things about my trade setup is that if I want to trade, I make sure that, let's say, I have 100% capital. This 100% capital simply means that is the money that I can afford to lose or I can risk. Okay. So let's say $150. Now, with this $150 capital that I have, the easiest way that I will go by it is by maybe using within $10 to $50 and then leaving the $100 as my capital to build up what we call my risk. So maybe I use $50 to trade. If I'm using $50 to trade, I'm leaving this $100 behind to protect the $50. I'm not going to use this $100 to trade to use $50 to protect $100. I don't know if you get the analogy. I'm not going to use $100 to trade to use $50 to protect $100. How can $50 protect $100? $100 can protect $50. If you understand, I don't know. I don't know if you understand what I'm talking about. Do you understand? Do you get it? Do you get it? Do you get it? Hmm? Do you get it? Very good. Very good. Yes. That's how it goes. So if you have $30, you want to use $30 to trade, $30. If it is $5 or $7 that you use to trade, it simply means you are going to use the $23 remain to protect your capital. Now, when it comes to capital protection, there are two ways to go by it. One, maybe you are using isolated margin or cross margin. Now, in both cases, you should be able to learn to understand the risks involved before you do what you go by it. Personally, I use cross margin. I do not use isolated in my trade, right? I use cross, not isolated. Meanwhile, isolation is good. Do you get it? It's good for someone who is afraid of taking serious risk. Yeah, let me use that word. So please, I'm not saying go and use cross. But the isolated margin is good for someone who is afraid of taking serious risk. Yes, because of how the cross margin behaves. Now, if you are using isolated margin, then probably opening margin calls will be the best for you. Opening margin calls would help you a lot on the isolated margin. Now, on cross margin, if I open margin calls, it's good. It will be able to buy more. But on cross margin too, if you leave your trade on open position, when I say open position, I have 50 $100 or $150. Let me use 150. $50 is in trade. $100 is just using as backup on the futures market, right? It's being used as what? As backup, which simply means your trade is on open position. So in this case, less trade, less supporting funds, more supporting funds. I don't know if you get it. Less entry, more supporting what? Supporting funds. So this capital becomes your reservoir, supporting this $50 to do to trade. And that is how the cross margin works. So whenever you are using cross margin, you realize that if you have $100 backup, it will keep going down. The $100 itself will keep going down. To keep going down, it keep going down. Meanwhile, your capital is still $50. That is called open position. Open what? Open position. So both margin calls and open position works on the cross margin. But it's advisable for you to use margin calls on isolated margin, which may help you a lot. Okay. Mind you, we are talking about risk management. Risk management. Now, the next part of it is stop loss. Stop loss as a risk management or risk aversion tool. Stop loss. Now, this has become one of the debatable um this thing in the financial markets when it comes to stop loss, where some traders believe that stop loss is less important. Other traders also believe that stop loss is very, very what? Very, very important. Do you get it? Now, when it comes to the use of stop loss, I don't discourage it, neither do I encourage it as well. Personally, I don't use stop loss, but I don't discourage stop loss. I always say that it is about how you it's about how you do what you understand what you are doing, right? In as much as stop loss work, personally, I don't use it. You get it? Now, let me explain it better to you for you to get it clear. So this is it. When we talk of stop loss, the idea is simple. I have $50. I'm using $50 to trade, but I am willing to lose $10, which simply means anytime the market goes against you $10, or anytime the market eats up $10 out of your funds, your trade will trigger for loss. Hmm? Now, personally, like I said earlier, whenever I'm trading, anyone who trades, what you need to understand is that if it is $50 you are using to trade, it seems that is what you can afford to risk. You can afford to risk $50. That's the reason you are using $50 to trade. Trading is such that it's about risk. Okay? So you are exposing money to a market. The market may either go against you or may go in your favor for you to make profits. On the futures market, mind you, are talking about the futures market. So If I join this market and I said I'm using $50, it simply means I am ready to make profits or loss with $50, right? I am ready to lose or make profits with what? With $50. Now, if that is so, why should I worry myself? Still limiting the potential of my capital, which is the $50 that I want to only risk $10 out of. If I want to risk $10, then let me get back into the market to risk $10 and then set aside the $40 elsewhere. Do you get it? So the stop loss helps this person because even though he exposed $50 to the market, but he's willing to lose $10 out of the $50. Do you get it? So to this person, losing $50, losing $10 out of the $50 will be okay for him in order not to continue the trade. But to the other type of trader, that's the reason I've always been telling you I don't criticize traders' decision, but I always want to expand your knowledge and understanding about something. That's all. Then you make the right decision yourself. So when it comes to stop loss, now I'm not willing to lose this $50 at all, but maybe $10 out of it. That's fine. Do you get it? That is fine. And I'm willing to make $5 profit out of it. That is okay. But to the other trader, he's saying that, oh, no problem. I know the nature of the market. So let me leave this $50. That is what I can afford. So am you going to use these $50 to trade? Expect my $5 profit. In as much as I'm expecting that $5 profit, the market could go deeper and extract maybe 50% of this $50, which is $25, before it gives me back my $10 and $5 profit. I'm okay. But on the other hand, there is this gentleman who also says that, oh, no problem. If the market extract $10 of my capital, it's okay. I'll just close the trade. I don't want any wahala. I don't want any wahala. So that is the idea. So both either using stop loss or not, it works. So sometimes I don't see the ideology or the idea, and stop loss is the best. And if you're not using stop loss, you are killing yourself. No, no. Do you get it? No. Trading, like I've always been saying, one, when it comes to trading, trading is about what you see on a chart, how you understand what you see, how you interpret what you see, and how you can afford to handle what you take into action. Now you see something, you take it into action. So the next thing is the risk management is about how to go about what you can afford. Do you get it? So if I know I have $50, how can I handle $50? If it is $10, how can I handle how can I afford to handle $10? Can I afford to handle it or not? If you can't afford, then what do you do? That is what you mean by risk management. Are we together? I don't know if you are getting the concepts. Do you get it? I don't know if you get the concepts. Hmm? I don't know if you get the concepts. Right? Very good. Good. Very good. Now, let me answer that question. So what I'm saying is that on the cross margin, that's $100. Like I said, you may choose to either open margin calls or leave it on open position, right? You can choose to open margin calls with it, or You used to do what? Do what you call open position by leaving that $100 just as a backup. That's all. Do you get it? Just as what? As a backup. That is all. Now, the next thing about risk management is either um trailing stop loss, applying what you call trailing stop loss, or trigger stop loss. Stop loss actually means trigger, a triggering price. That is all. Now, when we talk of trailing stop loss, actually this particular one really makes sense, and it's okay. Now, let's assume I set up a trade. You look at it on Royal Kill, so don't worry. I set up a trade. Okay. Now, my take profit target, the actual price or the entry price was around $3. I'm on long position. Long position. Anytime I place the arrow like this, you should get it. Long position. And my target is around maybe making $9 here. Okay. Making $9 here. Now, I can set up a particular price that if let's say the profit that I've made, if it keeps going down to maybe $5, I can set up a particular stop loss here. This time around, the stop loss is for my profit, not my losses, not the actual loss. But in order not to lose the total profit here, I can set up a triggering stop loss. That is what we call the trailing stop loss. Okay, that's okay. This is the actual profit that I've made so far. Maybe the market may keep going up. So when the price gets to $5, when the profits, when I lose out this $9 to $5, the trade should execute or close in profit. That's all what we mean by trailing stop loss. Do you get it? That is what we mean by trailing stop loss. So whenever I'm setting up a trade, if I understand trailing stop loss as well, you can also apply trailing stop loss in your trade, not only stop loss. Do you get it? So the stop loss is below this $3. The stop loss is that if the price goes below, but the trailing stop loss is that if I'm making profits, if I make profit and then the profit begins to vanish, I want to set up a target where the profit that I've made, at least I can be able to earn part of the profit and not to lose all the profits. So there are some of you sometimes maybe you set up a trade, realize that you are in $50 profits. Now the next thing you get back to the trade and then the $50 profit has turned to $5 profit. $5. That is where the trailing stop loss gets in. So you can set up that target. Okay, when the profit drops to $25, at least it's okay. Not because you want $25, but you are anticipating for this particular $50 to go up beyond $50. But anything could happen and the price could go down. Since the price will go down, the next thing that you have to do is to set up this trailing stop loss to ensure that the price, at least you can be able to do it, make some profit out of the 25 $50. Please, do you get it? Do you get it? Mhm. Good. All right. That's good. Okay, so now let's Okay, so someone saying no. Yes, so you just join. Yes, you just join. You just join. You just joined, right? Mm? Yeah, so for that one, I guess the session is being recorded as well. Since you just joined, the conversation was from a high speed race till now. So now let's proceed. Let's proceed. So when it comes to liquidation in general, applying some of these things helps traders to reduce their liquidation or um yes, manage risk. Okay, to manage risk. So especially if it happens that you add margin calls, you add margin calls to your trade on the futures market. Now, mind you, I'll get back on spot on the futures market. If you add more margin calls, listen, if you add margin calls to your trade, or if you add capital to your trade on the futures market, the first thing is it lowers your margin ratio. Now, when it comes to margin ratio, sometimes you see that it is in green and later it gets to red. Okay. So before you get liquidated, first you receive a message at least 80% of your margin ratio gets to 80%, you receive message, a warning that you will be liquidated very soon. That it doesn't take even a minute or a second, then you get liquidated. But what can save you is having more money. That is the reason why I said one of the easiest risk management tools that you can use is by using less of your capital as entry FBA, then more of it as secured funds to protect your trade and to help you. So let's go to Royal Kill. So um, all right, so this is Royal Kill. Okay, so you click on futures and you already have the setup. So mm, 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 mm. Okay, so let's have this. All right, so let's do this. Okay, so now when you look at this particular trade, mind you, it's already a setup trade, right? Now, when I set up trade, I've already set it up as in having it on my trading view and everything already. So now, when you come here, this is what you're going to see. Already, this trade is going to be on short. This is short position. Hmm? Short position. We will enter this trade. We are entering. Now, when you look at this, you're going to see 660, which is with a leverage of 10x, which is in an actual sense, let's say $66 or so. Let's do the calculation. When you look at this, they said 499,999. So now let's see, right? We already, everything is set up already. So let's assume it is zero. Let's do that. Let me clear everything. Very good. So Now, let's assume this is the minimum amount, this is the minimum entry, which is $5, 5.2. Let's do the calculation together. We are going to use 50 or $60. So our leverage is 10x. Okay. So let's do that calculation. 400 divided by 5.276 times the amount of money that we want to use. So 400 divided by 5.276 times 10 times 60. That is going to give us 45489. So let's see. 45489. Well, what is that? Okay, good. So which is approximately, let me make this place 9. Very good. 600, which is 60. Okay. Now, our leverage is 10x. Then a take profits of 1.5. So if you want to enter this trade, you can reduce your take profits anyway. But if you mind to, you can also follow. Right? Now, the first thing, let's look at it. So everything is on one shot. The trade should be on one shot. Then it's on trigger price, which simply means you are following according to the current price. Right? Good. Now, what again? So our callback is 0. Let's enter this trade. We'll get back to explain. All right. So let's go back. So looking at this trade, what we are saying is that when it comes to stop loss, as an example, okay? When it comes to stop loss, let's tap on the trade. So having this particular trade here, if we want to set up a stop loss as our risk management tool, first we click on this, right? We click on this, so click on close. Now, if I want to set up a stop loss, if I want to set up a stop loss, I just click on the triggering price. So those who for a long time has been asking how to set up a stop loss, I click on this triggering price. Then I click on 100%. So it depends. Listen, it depends, but 100% is okay. So I click on what 100%. Clicking on 100%. Now this is the current price of the asset. Okay, this is the current price of the asset. So, and we are on short position, which simply means when the assets rise, it's going to go against us. So now let's make a target here and see. So 0.0 2 or 0.3. Let me use 0.34 and see. So now 100%. Again 0.02 is okay. Let me use this. Now, which simply means that if I use 0.02, mind you, it is 0.01. That's the current price. So when the price rises to this particular, that is 0.02, this is the total estimated sell, the losses that you are going to make, which is 312. Now, let me choose 75%. What does it mean? It simply means that when it happens that if I'm not going to use all the 100%, it simply means that I'm not going to lose all, but 75%, when the losses goes against 75%, it will close. That is a stop loss. Now, if 25%, 50%, it simply means once the market goes against me based on my capital, 50% is going to do it is going to close at a loss of this. In same manner, if it is 25%, it simply means once I lose 25% of the capital, which is $78, the trade will do what? The trade will close. That is the meaning of the stop loss. Do you get it? That is the meaning of the stop loss. So that is it. Now, now look at this. When I click on 100%, you can see they said remaining position is going to be 0. It simply means at that point in time, I wouldn't have any amount left. If I choose 75%, they said remaining position is going to be 149. Now, if I choose 50%, the remaining position is going to be 298. Then if I choose 25%, 448. Do you get it? So basically, the idea of setting up a stop loss is simple using Royal Kill. So for those who would also love to set up a stop loss, please, this is it. Do you get it? This is it. Let me get back if you have any question. Let me get back if you have any question. Now, let's move on to the next thing. Not seeing the video. Oh, is my screen not visible? Is my screen not visible?
Might is that visible?
All right. All right. So please, if you have any question, ask before maybe I proceed to one or two things. If you have any question, you can ask. Very good. All right. So if you have any question, you can ask. Now, on the case of margin calls, let me get back to the trade. So back to margin calls. Now, before I set up a margin call, I have to determine the margin call limits. Do you get it? And like I've been saying, when it comes to futures trading, I don't advise traders to use more margin calls on the futures markets. At most is 5 margin calls. 5 margin calls. At most is 5 margin calls. Why? Now, one thing about the futures market is that no matter the length of your margin calls, liquidation can still break through. Liquidation can still do what? Break through your margin calls. That doesn't mean that the margin call is not doesn't work. But liquidation can still break through margin calls. In as much as you are going to make some profit on the margin calls, you shouldn't be greedy in opening too lengthy margin calls. That is one unique thing about the futures market. So at most 5 margin calls. 5 margin calls, right? 4, 5. Okay. Now, you click on margin configuration. I'm going to address few important things here as I've been doing, then we end the session. Now, as you can see, Verakio already provided this setup for you, and the question is why? Why this? The reason is that when it comes to trading on margin calls here, you can see what is the difference between 2, 4, 8, 16, 32. That is what I call it the double effect or the double up. So the double effect. Now, this has been made such that If I am trading, what helps traders is more money. Listen, more money. So more money, more money. Now, like I said initially from the onset about risk management, you are trading. You use $100 of your capital as your first buying amount, and you want to use $50 to back up the trade. That's not how we trade. The reason is that your first decision doesn't make your final decision to be correct. Do you get it? Hmm. Please, do you get it? Your first decision in the market doesn't mean that your final decision is accurate. So, if you want your final decision to be accurate, you have to create what we call safety margin. Safety margin. And safety margin is a common rule in finance. It's a common rule in what? In finance and even life. Safety margin says, I've taken a first step. Step one. Now, I need a full backup energy stronger than step one. I don't know if it makes sense. Which simply means whatever decision you are making, even if it requires 90% of your energy to make that decision, you should make sure that you have 180% energy to make the net to back up your 90% decision. I don't know if you get it. Do you get it? Do you get it? I don't know if someone is getting the concepts. I don't know if someone is getting the concept now. Hmm? Okay. Now, this is what we are saying. I'm just trying to make a little analogy here. Now, we say safety margin. You are trading with $150 capital. You went into the market with $100, and now you want to use the $50 as your backup. What we are saying is that in finance, what we call it safety margin, you must be able to apply safety margin in your trading. So, for instance, you used 90%. What you should make sure that to do next is the next decision should be 80% of your decision of your energy. Sorry. So if let's say my energy happens to be 90%, if all what I have is 90%, I don't need to use all the 90%. I just need to use 1% of the 90% so that I can use the 89% to back up the 90%. So, in a natural sense, what we are saying is that the double up effect works in trading, especially open margin calls, which simply means you don't need to first exhaust all the funds for the first time before you proceed to use this particular strategy. So now, the first time, let's assume the first time you entered into a market with $10. The second time, what you are supposed to do, you are going to double your first entry. So if it is 10, it's going to be times 2, which is 20. The next one is going to be 4, which is of your first entry, which is 40. It's going to be 8, which is of your entry, which is 80. Hmm? And then 16, which is 160. Then 320. What is the difference here? It simply means you even have more energy as things goes west as compared to the first. That is what we call safety margin in finance. So either you apply the double effect or the triple effect. So with triple effect, if this place is 2, this place is going to be 6. 2 times 3 is 6. Okay, 6 3, this place is going to be 18. In that order, 8 times 3 is going to be 27. I don't know if I'm right. Then 81, which simply means anytime you want to buy another margin calls, you triple the first result. You keep on tripling the first result till your money gets finished. And why is it so? Why is it so? Now, like I said, trading is like that. If you have more money, you can enjoy trading. You can enjoy trading and you will never stress yourself. If you have more funds, you can enjoy trading and you will never stress yourself. Okay? You enjoy trading and you will never do what? You will never stress yourself. So that is it. So please, on your margin calls, you take note of that. Now, in the case of you having margin call limit, first the buy-in amount. Okay, so on the buy-in amount, it may depend. Maybe the asset that you are trading, you've analyzed and then you've seen the drop, or it's a signal that is given that they've given you the drop. Let's assume the drop has been given. So always, what you have to do when it comes to the drop, total margin call limit divided by multiple buy-in ratio, or total call drop. So let's assume your total call drop is 30%, and then this thing is also five. So let's see. Right, that is it. So please, do you get it? All right. Now, if you have any question, you can ask. If you have any question, you can do what? You can ask. So that is it. 30 divided by 5, that is going to give you 6, which simply means the drop, it's simple. I've always been there is no fixed formula in trading. There is no fixed formula in what? In trading. So if it is 6, which simply means even though your total call drop is 30%, which means each place is taking 6. Notwithstanding, it depends on you. You can choose to lower your first to third, or your first to let's assume this place. So you can choose to make this, if it is 6. Now, if I make this place 4 or 3, I make this place 3, which is 6 in total, which simply means it's based on me to share the rest on this third to the fourth call, so that maybe the first call and the second call can be able to buy very fast. Then I delay in buying the third, fourth, and fifth. It's simple as that. Okay, because they hold the high amount, the high share, or the high amount in what? In capital, and I need to manage them properly. All right, so let me get back. You have any question? Ask your question. If you have any question, feel free to ask your question. Okay, so which mode is better for margin calls to be effective? In both cases, they works, but isolated margin is okay. Isolated margin, in both cases, they work, but the isolated margin is okay. All right. So if you have any question, you can feel free to ask your question. If you have any question, you can feel free to ask your question. Right? If you have any question, you can feel free to ask your question. Mind you, it's your question that will help me to be able to assist you or answer or advance the lesson. Other than that, I'm done. So, Lawrence, isolated margin will help you, but like I said, I trade on cross margin, not isolated margin.
Dilemma.
Okay. So, can I link trading view to Royal Kill to pick trades? No, no. Trading kill, I say trading kill. Trading view does not pick trades. Okay. So you cannot link your trading view to Royal Kill to pick trades. That's not how it works. So does the 6-6 mean the gap between the calls? Yes, of course. The gap between the calls, the drops, the call drops. Yes, the gap between the call drops. It simply means each drop will take a percentage, each percentage drop will go for a 6% interval before it drops again, 6% in that order. So the depth of 6% each, so it is going to give you the total of 30%. All right.
Dilemma.
Hello.
In my view, I think isolated mode is it works well for a person who's trading more than one coin. But if a person is
Pardon?
trading, I was saying, in my view, I think if a person is trading one coin, then cross mode is better. But if a person is trading more than one coin, I think isolated, they can opt for isolated. It will work well in
So
that.
he's asking, his question is based on margin calls.
Oh,
His question is based on margin calls, yeah. So he's asking, based on margin calls, which one will be more effective? That's the reason I'm telling him or her that isolated margin will help him. Because on the cross margin, either you open the what do we call it, the margin calls or not. Unlike isolated margin, where buying the margin calls will follow the pattern appropriately. On the cross mode, it doesn't work like that. So in a case if it happens you are okay, so let me see this question. What do I do when my short position goes against me? Long whilst I'm using margin calls, how do I recover profit? I don't get your question. What do I do when my short position goes against me? Long whilst I'm using margin calls. I don't get into bracket long. Can you raise your hand to talk? Let me see if your hand is up. Okay. So you've been asked to unmute. So proceed. We are with you, Ofosuhene. We are with you.
Can you hear me?
We can hear you.
Yeah. So I'm asking, what do I do when I'm in a short position, but the trade goes against me, it goes long. And then I am now in kind of loss. floating loss. How do I recover? How do I recover back my profits? I mean, I try to recover to at least even get to the amount of money I put in the trade.
Are you talking on the spot or futures?
Um, Futures, yeah, futures.
All right. Now, on futures markets, when you
Yeah,
invest money and the market goes against you, your chances are two. Either you close the trade in loss, or you wait for the trade to that is called partial trade. Okay, so you trade it in loss to be able to get back part of your capital. That is one. Or two, you have to wait. If you only know your entry was solid, you can wait for the trade to get back in your direction. That's all. So you can't force a trade. One thing that you need to understand is that you can't force a trade to get back your capital. Immediately you invest or you set up a trade, you understand the outcome, that it may either be positive or negative. Do you get it?
yeah.
And in that case, what you have to do is to either wait to see how the market goes based on your setup.
Okay,
I don't know if
okay.
you get it.
Yeah, I get it. I
All
was
right.
I was thinking I was thinking of let's say, I mean, if I move to a short position and then it goes long, can I open another position in a long so that I can recover some of the floating losses I'm losing with the
All right.
same coin?
So okay. So now that is called hedging. I did not talk about hedging this morning.
Oh,
I did
okay,
not talk
okay,
about hedging this morning. But then when it's in that case, the idea is not to recover that capital, but you can make some profits. Hedging, when it comes to hedging, let me say something briefly about hedging. When it comes
okay.
to hedging is like that I'm on long position, the market is going against me. I don't not because I'm not going to take the next decision because the market is going against me. But I've realized that the market has changed in direction. There is a change in direction over the market.
Yeah,
Okay. In that case, I can go for short. When I'm going for short, the short position can maybe help me to make some profits or even help me better to recover some of the losses that I've made on the other position. That is fine. But in sometimes things can twist, and whilst you take the next position, the market reverse back to your actual position, leading you to your second decision being in loss. So before you take that moment or that decision, you always need to ensure that the market's on right track, and any decision wouldn't cause harm to your trade. All right. Okay. So let me see. Let me answer the next questions in the comment section. Now, please how to set $100 trading in futures. All right. Hold on. Okay. So why do you always place 30% limit on the call? No, it is not fixed. It is not fixed. 30% call limit, call drop is not fixed. So I actually have not placed 30% though, but what I can use to clarify that it is not fixed. So there isn't going to be any explanation to why 30 because it is not fixed. Okay. I am on current trade and need your guide to come out of it. I am currently longing WOD and it has been shortened. I need a practical guide now, please. So you mean you've long the trade and the trade is going against you? Yeah, so in this case, it's either you, based on your analysis, listen, based on analysis, if you decide to hedge the trade, that is fine. But you can only hedge a trade when you've taken the consideration to realize that the market has changed direction and is going against you, right? Good. So please, with this practical guide, it would only be maybe hedging. That is, if you have the funds to hedge the trade. But sometimes it is not about taking a smart move. Taking a smart move doesn't mean you need to hedge the trade. It's by waiting instead. Especially if you don't have enough funds to hedge. It's rather by waiting. That is what is going to help you. And mostly, what I need to let me clarify this. Anytime you set up a trade, get it clear. the market will go against you first before it will bring back the profit. Please, do you get it? First, the market must go against you before it brings back to your profit. So, for instance, this trade that we've set, okay, the markets will still go against us. It is normal. Good. That doesn't mean that immediately that we set up the trade, we should still see that it will go in what, in profits. No, the market will go against you a period of time before you do what, you make back your profit. So it is normal. Do you get it? It is what? It is normal. Please, I don't know if you get it. Like when we started this session, I gave you a typical example. Now, this same broccoli, okay, this same assets. Now, on 9th of August, sorry, I said 9th of August, 9th March, I set up a trade. Now, on 9th March, it couldn't deliver. And later I realized there was a reverse in the market. For some of the trade, I hedged the trade. Some of the trades too, I left them because there was no much funds there. Now, what happened? I left the trade. I left the trade there, right? Now, in my case, I knew the risk management I've taken based on the setup, the entry setup. Okay, so in that case, I left the trade open and it kept running until maybe it was around 10 days before it's closed. So the first thing that you need to understand is your psychology, your patience to wait also matters a lot. Some people close their trade in loss, okay? They close their trade in losses, but I told them that no, you should have waited enough. So waiting also matters in trading. Your patience to wait matters a lot. Do you get it? So not always should you take a quick decision by closing the trade or thinking of doing something. So no, just wait. The waiting is based on a condition that you are okay with the setup that you did and you trust your setup. Fine. That one, it's your decision, so you respect it. All right. So why didn't you put margin calls on the broccoli? Yes, like I said, I left it on open position. When we started, I explained different types of risk management and I talk about open position as well. So it's on open position. Okay. Now listen, in an open position trade, that doesn't mean that you've ignored margin calls. Margin calls can be open at any time for open position trades. That is one thing that you need to get it clear. Okay, so if you have any question, you can ask. If you have any question, you can ask. Hmm. I guess you are taking you are taking us back. I explained all these things before we started the session. Bernard, I explained all these things before we started the session. So, um, what do you think I should do? Tell me. Tell me, what do you think I should do? I explained these things whilst we were learning. So I explained about the different types of risk management, how to apply them, stop loss, trailing stop loss, open position, margin calls. I did justice to all those things. All right. Now, when it comes to open position, so why do we, let me see. Okay. Why do we always have to enter the market very fast using small call drops? Why do we always have to enter the market very fast using small call drops? Now, first, you need to understand that in your entry, it only depends on um what position you are placing. Either it's based on current entry or um preset entry. You only enter very fast when it's preset entry. Now, call drops. The reason why call drops, we say that the first or the initial call drops, maybe the first, second, third should be very low, so that the assets can be able to so that it can be able to buy very fast at the moment. Do you get it? So it's part of risk management tools. So for instance, um okay, so now 1, 2, 3, 4, 5, and we said, okay, it is 8, 16, 32. Let me use 84 in that order. It can be able to buy the first drop, second drop very fast as part of your risk management in order to be able to add up to your first buying amount. Whilst you delay in buying because the market could go very deeper. In that case, if you push all the money in the market very fast, it may disturb you. So your first, your second drop at least should go in the market in addition to your first buying amount. Do you get it? Once you delay the next entries, which is the third, fourth, and then fifth, which carries or which holds high or huge amount of what? Of money. Please, do you get it? So we've been asking traders to do so because your first and second entry may add up to the first buying amount in order to control the trade, whilst you delay the third, fourth, fifth as part of your risk management in order to hold those positions as part of your risk management. That is the reason. Okay, I believe it's clear. All right. Okay, so what is the difference between sub-bin mode and sub-bin mode real-time settlement? What is the difference between the sub-bin mode and the sub-bin real-time settlement? Now, with sub-bin mode, sub-in mode. When it comes to sub-in mode, it does what we call redistribution of profit. Okay, redistribution or distribution of what? Profit. So, for instance, if I open up a trade, like my first call, second, third, fourth, why do I open that trade? In order that those call drops, in order that I may make extra profit, that is what we call the sub cells. Okay. Now, when it comes to real time settlements, the profits will be given to you, the trader. You will earn it in your trade or as part of your profits. You earn that profit freely. But when it comes to sub-in mode, those sub cells will be distributed to the market. Okay, those sub cells will be distributed to the market, and the reason why it is being distributed is to ensure that your average price can be closer to the current market price. That is all. That is the reason it's being distributed. Okay, because in trading, the more capital you have, the more capital you have, the more secured you are in the market. So those sub cells would always be distributed back to the market in order to sustain your average prices as well as getting it closer to the current price of the asset. That is the reason why subbing. That's the difference between the subbing mode and the subbing real time settlement. So the difference is the profit that is earned and the profit that is distributed. That is all. Okay. So all right. So I believe that is all. Benedict Ayensu. Wow, I can see Benedict is a Ghanaian. And see Benedict is a Ghanaian. Ayensu. Okay, so I believe that is all for today, guys. If there is no other question, you can feel free to ask your questions on the platform. You can always feel free to ask your questions on the platform, and we will be available to assist you. We will be available to assist you. If there is any other question, you can feel free to ask though. But the session is being recorded, so I want to end the session, or let me see. Let me stop recording rather. As Ghana for that's why we are recording the session, so I have to end the session so that those who couldn't get time, they would go to back to the YouTube. When the session becomes so lengthy, it makes it difficult for people to watch. So maybe we can end here. I have more time today though. Today is holiday and I have some time to spend with you guys. But unfortunately, we have to end the session so that those who would get back to us can be able to go to the YouTube and then watch the session. All right, so Ghana 4, yeah. Thank you so much for the powerful session. And thank you too for attending this session. God bless you. Okay, so um yes, God bless you all. Let's end here for today. We shall meet again this evening. This evening is for business presentation. So please, let's all get prepared. We can invite our team members. We can invite our team members, especially our prospects, to join us. Let our prospect join us. It is the business presentation is for prospects. So please, if you have someone, encourage the person to join the session this evening, and I believe it will them help them a lot. So Coach Mo will lead us in that session. Will lead that session, and I believe it's going to be an impactful session for our prospects. So tell your family members, your loved ones, your friends that there is a new crypto business that is going to give them more knowledge about cryptocurrency. So they should join to learn more. Right. So let's end here for today. We shall meet again in the next session. God bless you and have a good day. Bye. Love you all and enjoy your holidays. I know, yes, I know the holidays is not for only Ghanaians. It's for only Ghanaians. Hey, I'm sorry, I guess it's for only Ghanaians, right? Today is holiday. So those Ghanaians are enjoying the holiday. Please enjoy it. Enjoy your holiday. Why? Bye bye. We will meet again. Deɛ ɛyɛ a monhwɛ mo nso yie. Na monyɛ sika na mommrɛ yɛ bi. Bye.